Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, May 19th, 2025. Hope everyone had a great weekend. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So, today's key macro question is: should you downgrade the U.S. in your portfolio? Our answer: the Sell America trade is back on after Moody's downgraded the U.S. credit rating to AA1, citing significant economic and financial strengths that no longer offset deteriorating fiscal metrics. Moody's is now aligned with S&P and Fitch, who downgraded the U.S. to AA plus in August of 2011 and August of 2023, respectively. The downgrade amplifies Wall Street angst over treasuries amid persistent deficits, looming unfunded tax cuts, and historically elevated policy uncertainty. The House Budget Committee passed Trump's tax and spending bill 17-16 after deficit hawks in the Republican caucus secured a faster imposition of work requirements for Medicaid and faster phase-outs for Inflation Reduction Act spending and tax credits. House Speaker Mike Johnson told reporters he'll push to expedite Medicaid work requirements, originally set for 2029, stating to make it happen as soon as possible. The nonpartisan Congressional Budget Office says the cuts to Medicaid will leave about 8 million Americans uninsured. The next stop for the One Big Beautiful Bill is the House Rules Committee on Wednesday, where deficit hawks Chip Roy and Ralph Norman hold key votes. With a maximum loss of only 3 votes, Republicans need near-perfect party unity to advance the bill. Republicans from New York, New Jersey, and California threaten to tank the bill absent a higher SALT deduction cap, injecting regional discord into the legislative math. Further volatility looms in the days and weeks ahead once the bill hits the House floor and Senate, where deeper Medicaid cuts and other flashpoints will face heightened scrutiny. All told, we view congressional infighting and tariff revenues, which President Trump can and likely will wield as a carrot to appease fiscal hawks in Congress, as likely to result in more fiscal largesse, not less. This is structurally bullish for U.S. stocks and corporate credit, and structurally bearish for the U.S. dollar and U.S. Treasury bonds. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's titled United States Credit Downgrade. It says, hi, Skipper. Got a good one for you. On May 16th, Moody's Investor Service downgraded the U.S. sovereign credit rating from its highest level of AAA to AA1, marking the first time in history that all 3 major credit rating agencies have rated the U.S. government debt below the top tier. The last time a major credit rating agency downgraded the U.S. credit rating was in August 2023, when Fitch downgraded the long-term credit rating from AAA to AA plus. Following that downgrade from August 1st to October 27th, the S&P corrected 10%. On October 31st, Janet Yellen announced a significant adjustment to the debt issuance strategy, slowing down the rate of sales of long-term debt and issuing more short-term Treasury bills. This pivotal change in the QRA kicked off the following bull market run. Now that Moody's has downgraded our credit, how should we expect the S&P to respond, and what may be the next action taken by the Treasury or Fed? Great question. One thing I would say is with respect to the dovish net financing policy pivot that Treasury Secretary Yellen implemented, that actually started back in the fourth quarter of 2022. This was not they continued on with that in the Q4 QRA from 2023. But again, this is something that had already taken place. In fact, if you look at the share of bills as a total as a share of total marketable Treasury debt outstanding, bills went from about 15% in the middle of 2022 to about 22% by the spring of 2023, and have basically been at about 22% since then. And so the dovish net financing policy pivot started before the downgrade, and it just continued post the downgrade. To me, in our view, what was most impactful in terms of getting the market to rally sharply, recall that we had a sharp, significant rally in November and December of 2023. In our view, it wasn't what the client is suggesting, it was just dovish net financing policy pivot, which had already taken place. In our view, it was the pivot by the Fed. Recall that we introduced our Jim with the soft landing theme at the beginning of November of 2023, identifying that, hey, the Fed is now shifting to a strategy where it's no longer using tighter monetary policy to guide inflation, but rather jawboning in time. And that was a really material change in the Fed's reaction function at the time that very clearly was underappreciated by investor consensus, but ultimately got more and more appreciated as we rallied from November of 2023 all the way through February of 2025. So that pivot, which saw the Fed funds rate peak at a level that was below the baseline Taylor rule estimate for the United States, for the first time in any tightening cycle. We've never seen this occur where the Fed stopped tightening, increasing the policy rate before it actually got to a restrictive setting, according to the Taylor rule. And so, in our opinion, that was just a very, very clear warning sign to bears that, hey, this is the Federal Reserve that is very clearly trying to engineer a soft landing in the U.S. economy. We identified that at the time, and have obviously helped our clients remain on the right side of market risk, in part because of that thesis. So, getting back to the question, now that Moody's has downgraded our credit, how should we expect the S&P to respond, and what may be the next action taken by the Treasury or Fed? I don't think this is not a market. In our view, this is not really a market catalyst for anything. In our opinion, I mean, it's very clear that the U.S. has been on an unsustainable fiscal trajectory. That's not new news. Jay Powell called it out in the most recent Fed meeting. He's called it out on several occasions. The Fed's not going to do anything differently as a function of the downgrade. No regulated financial institution like pension funds, insurance funds, which have guidelines and regulations on the kind of on the credit rating of the debt securities that they invest in. They don't have to do any forced selling either, because we just went from a split AA rating, AA plus rating to a now unanimous AA plus rating. So there's really not much going on here. I think it's more headlines than anything. But what I think it ultimately signals is that the U.S. It's becoming more and more consensus that the U.S. is on this not only an unsustainable fiscal trajectory, that the congressional Republicans are actually on pace to make that unsustainable fiscal trajectory actually worse, which is very unusual given the party. But again, the party's very clearly moved left fiscally as a function of the President Trump's gravitational pull from a populism standpoint. And this all makes sense. This is exactly what you should be expecting in a forward-turning regime where populism becomes increasingly demanded by the voting public. And ultimately, the only way you're going to get legislation passed is on a durable basis is legislation that sort of addresses that, in our opinion. So, they're going to talk tough with Doge. They're going to do the Kabuki theater dance with Doge, and they're going to talk tough to create a narrative that there's fiscal retrenchment on the way. But at the end of the day, then on the net basis, we're going to wind up with more fiscal largesse than we had even during President Biden under Paradigm A. So investors need to be aware of that. At least that's our highest probability outcome. Maybe wrong on that, but again, we don't expect to be wrong just based on all the research we continue to perform for our clients here at 42 Macro. So we'll wrap it up there. Darius Dell here presenting our Macro Minute for Monday, May 19th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.